Our next guest says major risk factor for investors going forward is Europe, not the U.S. He's Jeremy Zirin. He's chief equity strategist at UBS Wealth Management. Jeremy, we're talking about the moves today. A lot of moves this week. How are you doing?
Doing okay. How are you guys doing?
All right. Are you surviving this week? And what are you telling your clients?
Yeah, that's a big question, right? So we're telling essentially clients to sit tight, that to ride out the volatility, that we're not telling clients to aggressively enter the market at these levels, despite the fact that we think that there's very attractive valuations in the equity markets, because we do have to work through some of the bigger risk factors. And I think with the volatility this high, with 4% moves every single day this week to the upside or to the downside, it's very difficult to make wholesale changes to portfolios when you can get essentially a full year's worth of return in one day.
Jeremy, identify the specific risk factors for us.
Sure. I think they're really threefold. One is what's going on in Europe, and can the ECB or the EFSF essentially ring fence the sovereign debt crisis that's going on the other side of the pond. The other two issues are domestic, and it's that really investors are wrestling with, are we or are we not slipping into a recession? And I think that the equity markets essentially right now are pricing in a mild recession where earnings fall 10 to 15%. But the preponderance of evidence that we see in terms of the economic data, in terms of the corporate profit data, still suggests to us that this is more of a slowdown in a weak economic environment rather than an economy that's plunging into recession.
All right, you gave us two factors, Europe and then slowing recession here. Did you say there was a third?
I did say there was a third. Thank you for correcting me. The third is, if we are in a low growth period, what is the policy ammunition that we have to start to improve and resurrect the anemic growth environment that we're in? We know that monetary policy is right now very limited. We already have a zero interest rate policy. We already have a Federal Reserve balance sheet that's $2.6 trillion. And from the fiscal side, right now fiscal stimulus is a dirty word. So the question is, if we are slipping into something even in a mild recession, what's stopping it from becoming deeper if we don't have the typical policy tools, both from the fiscal side and from the monetary side, to get us back out of it?
Hey, Jeremy, I want to talk about Europe. That's the first factor you've focused on, and it's one that many analysts or economists are saying could really set the stage for the rest of the year and into 2012. Is everything that's happening there what you would expect? Are the politicians there, the lawmakers there, whether it's President Sarkozy, Angela Merkel, doing what they should be doing to get those economies back on track?
Well, it's less about the economy and more about the issue of just the excessive debt levels, especially in the periphery, and more about the potential contagion from the periphery nations to the core. And that's what really has gotten investors rattled this week. It's not about Greece, Ireland, and Portugal anymore. It was about the rising government bond yield levels of Italy, of Spain. And when we saw those yields rise above 6% towards last week, and those are levels consistent with the point of no return that we saw for Greece, Ireland, and Portugal, that got markets very, very nervous. Now, the ECB has stepped in and started aggressively purchasing bonds, which has calmed those markets and have sent yields down to roughly 5%. So that's initial first step, a good first step. So the question that markets really have now is, how sustainable is that? Will the ECB continue to purchase bonds in mass enough to keep the yield levels at those levels to allow for Italy and Spain to continue to roll over their debt?
One of the other questions down here on the floor of the New York Stock Exchange, Jeremy, you had 4 countries in Europe effectively ban short selling. Can't short sell for some forward period of time. They're concerned that you're effectively interrupting the markets, not letting them do their job. What do you think about that?
I don't think that short selling bans are going to have very much of a long-term effect at all. It doesn't really change the fundamental problem that we see in Europe, that there is no essential backstop from policymakers and no effective confidence to investors that the backstop will be in place that can ring fence the problem. I think that the question still remains, do the European banks have enough capital, and does the ECB and the EFSF have enough ammunition and resolve to ring fence the problem?
So, Jeremy, with that context now, what do you tell people about U.S. stock portfolios? Should they be making moves to protect themselves? Should they sort of limit their positions in financial stocks here in the U.S., given potential exposure to what is happening in Europe?
Yeah, for a U.S. investor, we're telling them to underweight European equities. We think that there's better value in emerging market economies that have much stronger growth and still very attractive valuations. We like U.S. equities. We like the financial sector in the U.S. It's underperformed. It does have exposure to Europe, but I think that the valuations for those stocks and the limited exposure, the better capital positions that they have relative to 3 years ago, puts them at much less risk than the market is implying right now.
All right, Jeremy Zirin, Chief Equity Strategist at UBS. Thanks for joining us. I'm sure you got a lot of phone calls to go return, so we'll let you go.
That's true. Thanks a lot. Have a great day.